Hey everyone, my name is Kyle Peters. I'm a CPA in Massachusetts. Today I want to go over S corporations. A lot of small businesses end up choosing to file as S corporations. I kind of want to go over the main benefit as to why people do that today. And I also just want to make people aware that this is an option. I talk to small business owners all the time who don't know anything about this. They don't know it's an option, either because their old tax preparer never brought it up, or for whatever reason just told them not to do it, even though it often does make sense for them to do so. However, there are a lot of good accountants out there. Find one that you trust and definitely talk to them about this before making any sort of entity selection. This video is not meant to be an all-inclusive video on entity selection. I kind of want to just go over the main benefit of S corporations and why people choose them. And that is for self-employment tax reasons is the big one. So I have some numbers here. I'll go over those in a minute. If you work a job, you're going to get a W-2. It's going to look something like this. It'll have your wages. It'll have the tax that you had taken out of your check for federal income purposes. And then it's going to have these two taxes here, Social Security and Medicare withheld. So on 150,000, it's going to be, a little over $11,000 in tax for Social Security and Medicare. So when you work a job, you have your portion withheld, and you also have, there's another portion that's withheld that your employer pays. So the actual tax is double this, but you only pay half of it. So when you go to work for yourself, what's going to end up happening is you're going to pay both halves of this. So it's going to double, or at least almost double, your Social Security and your Medicare taxes. And that ends up being obviously pretty costly. That's an extra $11,000 in taxes. And so when people elect to be taxed as an S corporation, this is the tax that they're going to try to get out of paying. So when you are an S corp, what's going to happen is the income from the business is going to all flow through to your personal return. So all the income, you're going to end up paying your federal and your state income tax on your personal return. But the income that goes from the S corporation is not subject to this tax. And that's what people are trying to avoid. So I'll give you some numbers and then I'll talk about how this works out cash flow wise. So if you have a job, you make $150,000 a year, you're married with two kids, you're going to pay $11,498 in federal income tax. You're going to pay $11,475 in self-employment tax for a total of $22,973 in taxes. If you're self-employed, you make the same $150,000, married with two kids, you're going to pay $4,729 in federal income tax. You're going to pay $21,194 in self-employment tax and $25,923 in total taxes. So as an S corporation, assuming that you run yourself a reasonable salary, because that is a requirement, let's say that reasonable salary is $75,000, you'll pay $8,198 in federal income tax, $11,475 in self-employment tax, $19,673 total. Some people will pay themselves no salary. That's not a good idea. The IRS does require that you pay yourself a reasonable salary. That is a gray area as to what is reasonable. But let's just say you decide, screw it, I'm not going to do that. You would pay your federal income tax only because you're not paying any self-employment tax because you didn't run any payroll. And you would, your total tax would only be $6,500. So yeah, the difference between being self-employed and an S corp running yourself a reasonable salary can save you up to $6,250 and up to $19,000 if you just choose not to run any. So, again, don't do this. But now, what's reasonable? Again, talk to a CPA about. A good place to start is if you had to hire someone to do your job, what would you have to pay them? But on top of the tax savings, this ends up really helping people as far as cash flow, because what ends up happening when people don't elect to be an S corp is they often don't make their estimates and they get themselves in quite a bit of trouble. So let me just go over a couple of 1040s real quick. Let's just start with someone who works a job, right? Your 1040 might look something like this. Again, you've married, two kids, $150,000 in wages. You're going to get your standard deduction. You're going to have your tax, child tax credit, total amount of tax owed. Let's say you have 10% withheld from your job. So $15,000 in taxes is withheld from your W-2. This is what this would look like. That self-employment is withheld from your paycheck every week, so you don't have to worry about that on your return. And so you actually end up getting a refund at the end of the year, like $3,500 refund. You know, you had enough tax withheld to cover what you owe, and the self-employment tax is withheld from your check every week. So we're good. We're getting a refund here. All right, so now let's look at, you know, a 1040 where you're working for yourself. This is what really kills people. So now we have $150,000 worth of income. It's on a Schedule C. We didn't have any self-employment tax withheld, the Social Security, Medicare, because we don't have a W-2. And we didn't make any estimates throughout the year, and we didn't have any federal withholding because, again, we weren't on payroll. And most people that I run into, especially when their new business is getting started, they just don't make their estimates. And then this is what ends up happening. We have our federal income tax, we have this self-employment tax that we have to pay, and we haven't paid any taxes in throughout the year, and we get this $25,000 tax bill. That's obviously, you know, something that's going to catch a lot of people by surprise. They're not ready for that. They didn't make any estimates. Oftentimes they don't have $25,000 to pay, and then they end up having to set up an installment agreement with the IRS to pay this over time. And if they don't make their estimates again, then they owe more money at the end of the next year, and then this just kind of perpetuates, and they end up with real tax problems. So let's look at this. If we run our S Corp salary, 75,000, what this would kind of look like. So, you know, maybe we have $75,000 that goes through payroll, and then another $75,000 that just flows through from the S Corp. So it's still $150,000 in income, but any of the self-employment tax we need to pay, we already paid on a W-2. So your W-2 would look something like this. This is from your own company. So this taxpayer is John Smith. So this is John Smith's company. So he paid himself $75,000 through payroll. The necessary taxes got withheld when he ran payroll. He would have paid twice this because he paid this, but also his company also matched this. So the numbers I showed on the spreadsheet take that into consideration. And he had some federal income tax withheld. Again, we're assuming like 10% here. So we don't have to worry about self-employment tax at the end of the year. And we've paid $7,500 in. We owe $8,200 roughly speaking, and maybe we owe $700 to the feds. Like, okay, that's manageable. We can pay that. This is actually an interesting example about how the cash flow of things work. So let's just say you do an S Corp, but you have no income. Even though you pay less in taxes, this person who didn't run themselves a salary at all actually is going to end up with like a $6,500 tax bill. And again, this is just because they didn't have any withholding. So having withholding and making estimated tax payments is actually a pretty big deal. And again, just, you know, most people don't do it. They don't know how to do it. They don't know how much they should be paying. They don't know where to pay it. And so having a CPA to help you with this is really helpful. You should be running yourself some sort of payroll if you're an S Corp. You may still need to make some estimates depending on where your income's at and what you're withholding from your W-2. But yeah, the self-employment component is the big deal that most people are trying to save. There's some other stuff, QBI, pass-through entity taxes, you know, good for a lot of people who are at a certain level of income. And there's some other things, but this is kind of the big thing. So I just wanted to go over that, make that clear. Hopefully that's clear. And if you have any questions, feel free to reach out to me and ask. I'd be happy to go over this with you. And again, just talk to a CPA before making any decisions about this. It doesn't necessarily mean that this is going to be the right move for you. Thanks. Have a good day.